Picture this. You finally do the responsible thing and start saving money every month. You move a little bit into your savings account, $100 here, $200 there. You feel good about it, responsible, disciplined, financially mature. But then, one day, you open your banking app and realize something strange. Your savings account has $10,000 sitting there, and it is earning something like 0.5% interest. This means after an entire year, you have made $50. Meanwhile, you keep hearing people talk about investing, stocks, index funds, and compound growth, and suddenly you start wondering if you are doing this wrong. Saving money is good, but saving alone rarely builds real wealth. This is where a lot of people get stuck. They know saving is important, but they have no idea how to transition from saving to investing. So today, we are going to break down the exact step-by-step path to turn saving into investing without feeling overwhelmed or risking your financial security. Let's start with something that might sound controversial. Saving money alone will almost never make you wealthy. Look, saving is important, but it is not the final goal. It is just the first stage. Savings protect your money, while investments grow your money. Those are two very different jobs. Let's look at the math. Imagine you save $10,000 in a typical savings account earning 1% interest. After 1 year, you have $10,100. Not bad. But now let's compare that with investing. Historically, the stock market has returned about 10% per year on average over long periods. If that same $10,000 earned 10% annually, after 1 year you would have $11,000. That difference might not seem huge at first, but the real magic is compounding over time. After 20 years, savings at 1% equals about $12,200. Investing at 10% equals about $67,000. The biggest wealth gap isn't usually between people who save and people who spend. It is between people who save and people who invest. But most people never make that transition because saving feels safe and investing feels risky. That is exactly why the transition should happen in stages. First, build a real emergency fund. Before you invest a single dollar, you should have 3 to 6 months of living expenses saved in cash. This money protects your investments from your own life, so you never have to panic sell during an unexpected emergency. Second, separate saving from investing mentally. Think of them as two different buckets, safety money and growth money. Third, start investing small. You do not need thousands of dollars. You can start with $50 or $100 just to build the habit. Fourth, focus on simple investments first. Avoid complicated strategies like day trading or crypto speculation. Instead, look into simple index funds that track the overall stock market, allowing you to invest in hundreds of companies at once to lower your risk. Saving money gives you stability, but investing gives you freedom. The earlier you combine both, the more powerful your financial future becomes.